Okay, testing, 1, 2, 3, testing, 1, 2, 3. The rain in Spain falls mainly on the plains. The ants in France stay mainly in your pants. We got sound? Are you alive? Who's here? Let me know if we got sound. Never really know. Anyways, it's 8:01 in the a.m. New York City time. Welcome to the beginning of the rest of your day. Technical analysis, fundamental analysis, focusing on the currency markets. Yes. So we got the stock market opening just around the corner. That means volume and volatility is on its way. So let's get ready for that. And also let's plan for tomorrow. Yeah. If you already don't know what you're doing today, you've already lost. We planned today yesterday. So today we're planning tomorrow. You got it? 3, 2, 1, hit it. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never, ever risk money you cannot afford to lose. Hello, my name is Wayne McDonald. I'm a currency trader just like you. I'm a lover of macroeconomic trends, and I love trading those trends. So today we're going to cover analysis based on what? Scalp trading, spot trading, position trading, market open trading, carry trading. All right? From the 1 minute chart to the daily chart, and everything in between should be part of your analysis. And then a whole bunch of stuff off the chart. So anyways, welcome to the group. There is now 17,100 and something subscribers, which means we're all foreign exchange traders stationed around the world. It's pretty amazing. So if you're going to be part of this community, A, check the negativity at the door. B, get involved. I see that the people that learn the most are active the most. Okay? And if you're watching a recording, leave comments and be active in the community that way. But you need to get involved. Lurking doesn't make you a better trader. So anyways, ask questions, get involved, take notes, leave comments, treat your fellow currency traders with dignity and respect. Also, I'd like to remind you, you're in my office, so, we want this to be as professional as possible. So you can show that by asking, amazing questions. Cool. I'd like to thank you for being part of this community. Otherwise, I'd just be kind of, talking to the geese that sit in my yard this time of year. So you're better than geese. Oh, for sure. By the way, did I ever introduce myself? My name is Wayne. Been doing this a while. Cool. What is that big book behind you? Oh, you want to know this big book? Okay. This is one of the economics textbooks I have from Harvard. And since I'm doing the macroeconomics course, I thought, I wonder how they do macro. This costs more than the course. And I'm telling you, this is not a light book. And this is one of dozens. So I can make this, though, easy to understand. Yes, I have nowhere to put this thing. Ugh. So anyways, that's what that book is. Grumpy Cat, how does 100 to 1 compare to 30 to 1 in trading? 30 to 1 is just fine. Okay? Most of the capital you shouldn't be using anyway, so you're fine. What book on game theory will be in the book club? I don't know. See, I remember reading one small one and then a bunch of other textbooks with game theory in it, but I don't know. That'll be, eventually what I'd like is for people, I'd like to ask people what they're interested in and then have people sort of vote on books. But we're not quite there yet. So anyways, what I was saying is I've gone over the very complex ideas and models in economics. I can translate that into common sense so we can figure out ways to invest our money and make some profit. Very cool, right? So I'd like to thank you for being part of the community. I'd like to thank Traders Way for being a part of the Forex.Today community for the last 6 years. You're a trader, they're a broker. They want you to be educated. You want to be profitable. So as you can see, it's a symbiotic relationship. You push, they pull, or whatever, or they push, you pull. But one way or the other, you want to be a successful trader, and they want you to be a successful trader too. So maybe it's an opportunity to develop a relationship, huh? Visit tradersway.com, ECN account, fixed spread account, variable account. I like the VAR. I've always done VAR, but I'm old school. But it's your way at Traders Way with Trader Wayne. What are you guys saying in the chat here? Random, what book name? What are you guys talking about? Grumpy says the industry is changing in Australia in March. Oh, you're saying you 30 to 1 instead of 100 to 1? You'll be fine. Okay? If you're ever in a situation as a trader where you're like, oh my God, I don't have enough money in my account to cover my margin, you're screwed. So you'll be fine. Don't worry about it. Yeah, I'm starting a book called Cave. Where you been? In a cave? Yeah, I think my programmer, he hasn't said it, but I'm pretty sure he was very sick, aka maybe COVID. So I'm trying to be as patient as I possibly can, and he's run into some problems and whatever. So he's back on board working, begging to not be fired. So anyways, let's all be patient. Cave here a bit. Yeah, we're starting a book club. All right. All right. So let's just take a look. Pig, great big pig. Great British pound is still quite strong. Euro is still quite weak. We'd expect euro to be weak if dollar is strong. So if dollar is strong, euro is weak. The decoupling has now continued. Dollar is relatively strong. Yen is relatively strong. So it's interesting because there's quite a bit of signs here that shows there is risk in the market. Oh, okay. Yeah, I'm not sure what you're talking about, bro. Maybe someone said something earlier. It was just someone asking about. Oh, you're saying it's a game theory book, random something. Yeah, no. I'll see if I got a game theory book. I don't see. I have like 3 different places I keep books, so I don't see any there on game theory. It wasn't a very big one, but like I said, very often in various different types of classes, there was like sections of books that focused on game theory, but there was one small book in my game theory class that we would read, and it was only really interesting. I mean, the lecture was better than the books. Because the books are often like, okay, in this kind of game, this is what happens, and here's how you play it. And this second type of game, and this third game, and this fourth game, and this fifth game. And then if you change your variables in some of these games, then the behavior changes. And then if you change the rules, and then the behavior changes. And after a while, you're just like, oh, one game after another. Right? Cool. All right, so so the way I'm kind of looking at it is the great profit taking that we've been waiting for seems to be more focused on the US dollar than anything else. Okay? Wonder if that happens to do with the stock market being so expensive. Okay, cool. So generally speaking, euro's a little bit weak or quite weak because of the dollar strength. and all that kind of stuff. Great. So CAD yen still moving up with oil prices. Okay. Up we go. Okay. I think what we talked about yesterday was this, wasn't it? Look at these steps. Like I see the step off the bottom, step off the top. It's like climbing a ladder, right? So now you got to drag this and see if you get a second chance or third chance or fourth, whatever you want to call that. But it's just doing its thing. Okay. But I think that has more to do with the situation with oil. Okay. This is a little bit frightening, right? I'll say it because investors or traders are expected higher highs kicking off the 21 and moving up and all that kind of stuff. And the reason I say this is a little bit scary, or maybe even very scary, is we didn't get the higher high, okay? And that also could set up a head and shoulders, don't you think? That's why you want to buy low and not somewhere in the middle. Okay. That's probably what you're talking about, HK. Okay. Yeah, so it's not there yet, but you certainly could be on this. And you're trading as if it's going to, right? And of course, imagine that the inverse of this buy zone is the sell zone. So, yeah. No, it's dollar focused. Okay? There's been quite a bit of dollar focused profit taking. Okay? So, let's address Un's question. Would you say there was no profit taking yet? So you would look at euro dollar, for example, and say, oh yeah. Okay. So remember, where's my drawing tool? Okay. The plan was to expect somewhere in this period down instead of up. See, this is pointed down here, but remember, we were not thinking down, we were thinking up. This is pointed down, but remember, we were not thinking down, we were thinking up. This is pointed down, but remember, we were not thinking down, we were thinking up. This is the, excuse me, this is the only period we were actually expecting down. Okay? The most liquid currency pair in the world. Okay, so the way to think about it is kind of like this, where, okay, how would you feel now if the past didn't exist, okay? And I said to you 16 weeks ago that somewhere inside this pink box, oh, I didn't mean to do it that way, sometime in that period in the box, that euro dollar would fall. So now I would ask you, do you think it fell? What's your answer, On? Yeah, Michael, yeah, if you're going to sell off that head and shoulders, yeah, you do it off the right shoulder for sure. Right. Yes, it fell. So on me predicting profit taking at the end of the year, but I'm talking about America. Okay, I'm talking about Americans. Oops. Okay. So it seems to have happened. And remember, I drew this to show you that there would be a breach. So remember, when you're a trend trading, you have a primary. This is your primary. And you have your secondary. Okay. The secondary is kind of like a guide, and it's really measuring the consistency of the velocity or the consistency of the cycles. Okay. The primary is the support holding the uptrend up. So a breach of the primary trend line is the end of the world, end of the trend. Okay. Yeah, that's another, Master Trader's right. The other way of looking at it is like a deviation. How far does price tend to rise off the support line? Yep. Okay. So in statistics, you would measure the mean and the standard deviation from the mean, and you would have things like this. Okay. There's different, I look at it like quadrants. Okay. There's just, right, rising consistently above or rising consistently below, but a break is just way out. Okay. So here's a front run. Here's the second chance, simple role reversal, right? All you had to do is sell it at 22, right? Or sell it at 23. Okay. So now what you're doing is this, and what you're expecting is something like this. Gotcha? Okay. I mean, there's a lot there. You should be able to pick up some of those trades. I imagine you are. Okay. It's the end of the world as you know it. Okay. So, if you're a bull, you're going to say you want this to hold. If it's time for it to come back down, you're going to kick it off the future, right? The future 21. Or sorry, the future 55 is what I was trying to say. Okay? So you'd be looking at it like this, I think. I think it's a bit aggressive to think the 21 will go up. You might do it, but I think you're already in it. You're playing this role reversal up here, okay? But here's my thought process. If you think more down before the next up, it won't come down to where the 55 is now. It'll come down to where the 55 will be in the future. Marcel says, do I use pitchforks? No, but it's covered in the FX Bootcamp original bootcamp course. David Pegler, I respect the most. In fact, I call them Pegler pitchforks. But there's a lot. So like, for example, here's why I don't use pitchforks that often. You sort of have to determine what points you measure. Okay, and you might measure that as a bottom. You might measure that as a bottom, and it's changing, right? I don't think you use that as a bottom. And then you have to make decisions on, like, when do you adjust? Okay, so as you're going, maybe you might be using in the beginning right? Which high do you use? And then you adjust to here, and then what? Right? And then what? So new high, new high, new high, new high, right? And then you have to adjust your low. As you can see, and it's fighting me, just trying to show you. Amazing how much it's fighting. There we go. It matters a lot on your decision of when to adjust the tool. And I don't like that so much. Okay? All right. So, for example, you might still have it set like the original, right, move. You might have it set like this. And someone else might have it set off this top, or this top, or this top. Okay? And it matters. I like to try to take that decision-making process out. Instead, I like to just use statistics. In statistics, it's just math. There's no sort of adjustment. Okay? So, if we were going to create an average over this period of time, and then a standard deviation from that moving average over this period of time, it's just math. Everyone will get the exact same answer. If you're measuring, let's say, from the beginning, January 1st to today, see, I'm not actually, watch my mouse, don't watch the line. My mouse, I'm saying to the math, actually the math is way over there. Let's do this again. I'm starting on this candle, and I'm going to drag my mouse to the right. I'm not even going to touch these candles. All I'm saying is from this period, and this period, and this period, and this candle, count this candle, and that candle, and the next candle, and the next candle, next candle, next candle. And what it's doing is it keeps doing an average. And then a standard deviation. It's just math. So if we say go from January 1st to today, look at my mouse. I'm not adjusting the slope at all. I'm just going to all from the first candle to the last candle, and I let go. And that is the math. Okay? We will all get the same answer. And it's probably very close to how most experts would have their Andrews pitchfork, but there's just too much variable or too much decision making, or like I don't like the situation if I gave everybody Andrew's pitchfork and say go, we'll get very different results. If we all use statistical analysis, we will all get the same results. Okay? Oh, you're saying his newer stuff, Master Trader? Well, I would assume everyone's made tweaks over the years. He's getting better and better and better. Okay? London HK would be my assumption on the highest volume. Okay. Okay, cool. So anyways, what do we know? Well, if we're going to measure standard deviation, you can see that it's still technically bullish, but it's cooling off. Oops. Okay? But that's what the moving averages are telling us as well. It's still very bullish, but if we drop from the 21 to the 55, it's a lot less bullish. Okay. Oh, yeah, this is me picking on the inverse flag. I'm like, don't trade patterns, trade logic. Sure enough, remember I'm even joking, like, I was pretending you were talking to a client and you had to explain you lost their money because you traded an inverse pennant pattern and it didn't continue down. Instead, it reversed. It's not your fault. The pattern failed. I'm like, I don't trade patterns. They're useful, but to make a decision because of a pattern is silly. Cool. Natty. So I think on Monday somebody wanted me to analyze nat gas. Okay. And right, here's the buy zone and here's the exit zone. Very nice. Okay. And this move here, I'll do in a different color. Because of this situation, one would plan on getting back down to here. Okay. And of course, a bull would then be front running next week and doing this. Okay. Grumpy says, oh, you don't Fibonacci? Fibonacci is pretty easy. It's just measuring frequency. Okay. Here's how I think of it. If you're a bull and you're saying, okay, that seems to be a bottom, this seems to be a top, and then it seems to be turning back north here, okay, where should I expect price to go before it becomes exhausted again? That's all it does. Okay. So for example, a 382 would predict a 1618. Cool. Okay. It's just a guide. I consider it almost like the same function as an oscillator. It's helping you kind of project overbought and oversold conditions. Well, yes, Elliott wave is probably 50% Fibonacci, just right off the bat. And then he says, so think of it this way. Let me go blank on this one. Template, blank. Think of it this way. We know that the market moves like this. But we also know the market has, let's do this in blue, smaller term moves, okay, like this. So let's say weekly trades inside of day trades, okay? So then Elliott waves notice right away that there's a big Fibonacci move here, right? Right? And that each one of these have Fibonacci moves. Okay, great. Cool. Right? So this looks like about a 50%. This looks like a 382 and all that kind of stuff. And then Elliott, Mr. Wave, started saying, okay, well, that's interesting. How can I anticipate this move, and this move? Okay? Well, by definition, if it's trending up like it is, there will be more up than down and more pressure to push it back up. So then you define that there's differences in the in sort of the frequency, meaning if you have a 2 Fibonacci retracement, so let's do it this way. If you have a small retracement, it's very, very bullish and it'll have a higher extension. Then if there's a bigger pullback, it's much less bullish than it was, even though it's still bullish, and it'll have less of a new peak. Okay? So let's say on a 100 pip move, a 38 pip retracement would give you, essentially a 100 pip move, where a 60 pip retracement would give you about a 30 pip above the old, right? Okay, so the extension, because it's more bullish, would give you a 100 pip above the old shoulder, where one that has a lot less bulls will only give you a 30 pip above the shoulder. Okay, and then he started looking at, well, there's changes. I call this frequency, truly like an oscillator, right? Like a sound wave. That's right. So then you would then study and say, well, if there's a big macro move and lots of micro moves, he started using things like, okay, you get 1, 2, 3, 4, 5, and then it's got to take a little break here, and the one, all right? And then he started counting. So then you would say, okay, this is a 1, 2, 3, 4, 5, and then what? An A, B, C, whatever, and then counting back up. Okay? And all he's trying to do is say, if that's the general move and this is the micro move, right? How do I analyze all of that? And each one of these, of course, moves is a Fibonacci. Okay? So he's doing Fibonacci inside of a Fibonacci. I think. I've never actually read a book or watched a class on Elliott wave. It just makes sense. So like I don't have a problem with the methodology. I just wouldn't trade like that. Because initially it makes sense, but in my opinion, if you and I hear this from people that come and stop by the webinars for a while, and there's been some certified Elliott wave professionals that I've coached, and they'll say things, oh, because of this wave, it has to do this. I don't even like the thinking. I don't even like having a conversation around that. Okay? It just doesn't make sense. Like I get it, but it doesn't have to. So you're right, but that's sort of the logic. I can't think of an analogy, but imagine a very, very religious person that has total faith in God talking to an atheist, right? And they're trying to like reconcile some sort of discussion or not even an argument, just a discussion. But the logic of these two people talking to each other through that gap is very difficult, if not impossible. Now, they would have to change their language or something to get past that, to understand each other. And so, like, for someone coming up and telling me this has to do this because of that, like, oh, well, that's a C wave, in a correction, and the next thing will be a 1, right? A 2, and then a 3. It has to be this way. And I'm like, okay, I don't disagree, but just the idea that you would throw down money based on just that pure belief that that's going to happen versus there's a difference between awareness and belief, I guess. In that case, like, if it'll happen, I'll probably trade it. An Elliott wave person will trade it. I just don't like counting waves and saying, well, because we're on a C wave, it will have to do this. I'm a macroeconomic trader, so I'll say things like, because of what the Fed said, then I'm going to have a certain behavior, which is different, but maybe even you could even argue that, well, that's exactly the same. Now, I believe everything based on fundamentals. And I'm like, yeah, well, I've always said that. I start with the fundamentals first. And there's too much, I think with Elliott wave, there's too much reliance on a technical pattern. But a technical pattern doesn't tell me what OPEC did last week. And Jimbo says, right, Elliott wave is used more for probability. But whether it's been trained that way or it's just human nature, I have definitely seen, Jimbo, people that don't look at it as probability, but as certainty. Because it's done this, it has to do that. I'm like, no. Fundamentals will probably dictate that, and then people will make decisions around it, right? So that would be perfectly so I'm agreeing with you, Jimbo. And in that case, it would be people that understand it perfectly but are applying it incorrectly, right? And I like the idea of the probability stuff, especially filtered through, right? Filter through fundamentals. Right, and you're right, like any other indicator. Yeah, so, trading something because of a pattern, trading something because of what MACD told you, that kind of stuff is really silly. And your client won't like it when you lost money, right? And you're like, well, it was a 5 wave, so I sold. Oops, but it went up higher, so I guess it was a 3 wave. It just doesn't compute into a valuable discussion with a client. So you'll always need to rely on you made a decision based on fundamental analysis first, and then you use scientific methodology to confirm the price and time in which you entered your strategies, right? Much different logic. Okay? Yeah. Okay. Oh, what's going on, Jim? Looks like there's a side one. Yeah, no, I don't believe he has outside videos. What should we do? Well, let's go look at dollar. Okay, so here's our dollar strength. Very cool. We're now days and weeks into this. Remember, I hope you guys don't just stare at these things. Oh my God. I hope you guys don't just stare at these things. Honestly, I hope you don't just stare at these things. Thank you, Mike. Yeah, impulse versus, yeah. Yeah. In the video course? No, the indices are just indicators. You just buy them at MetaTraders. Well, the issue isn't timing, so let's focus on that, right? For me, the issue is it's a timing issue is the question, okay? The way to remove that is trade on bigger time frames. And right? Now use a demo account till you get this. Look at bigger time frames first and use limit orders to get into your trades. Okay? By longer term, I mean like have a 100 pip stop. And you're like, I can't afford a 100 pip stop. Okay, well then use a demo account or just for fun, drop it to a micro lot or whatever. But start on a higher time frame, at least in your analysis, and then maybe day trade it or something. But my point is to remove timing, you need to have a bigger stop so that if your timing is bad but your strategy is good, you will make money. I want you to remove timing. Like you might end up being in your trades 5 or 6 or 10 or 12 or 18 or 24 hours early. Probably not if you're day trading. If you're swing trading, you could be in the trade 2 or 3 days early. I don't mean like take 100 pip losses. I mean plan your trades properly. But typically, for you to lose 100 pips, right, you have to actually be wrong on the strategy, meaning in this case a trend. You are a bull in a bearish market. You are a bear in a bullish market. You have to be so bad as a trader that you get knocked out because you're 100% completely wrong. It wasn't a timing issue. It was a strategy issue, right? Yeah, yes, probably am, Grumpy Cat. It might be cigar day, sit outside and get some sun on my face day. I've had a lot of dental surgery I think like 50 shots of Novocaine. My jaw was so tight. She's like, do you have a stressful job? I'm like, why? I can't get the syringe into your jaw. She's like, it won't go in. The syringe just won't go back in here. So she went, bup, 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 like no joke. About 25, 30, 40 Novocaine shots here, and then 2 days later, 30 or 40 Novocaine syringes. Bang, 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 bang. You can hear bang, 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 bang. So anyways, maybe that's what's doing it. Okay. Seems like... actually, I find trading very comforting. I don't have stresses per se. I worry about you guys. Okay, I worry about you guys. I think what I'm going through right now, especially in transitionary times, there's a lot of stress to say weeks in advance that this is going to happen, and then I worry about a couple of things. One, you don't do anything and you just watch it, or the second thing is you bet it's going to happen. And both those things are not helpful to the growth of your potential, your success, right? So, maybe that's it, right? That I do care and I do worry about you. Okay? And of course, I worry too that many of you have just gone through the best period of your career by far. You never dreamt you'd be this successful. And I worry that enthusiasm could be destructive, because I've seen that too, where what I keep preaching is staying small, staying humble, right? Focusing on the long term, always have a plan, and always be prepared to be wrong. Always have an exit strategy, right? Right? Like, again, the analogy is the young platoon leader straight out of boot camp, walking into a situation, and all of a sudden the hairs on the back of their neck stick up and they're like, ooh, this could be an ambush. I want you to listen to these versus just like, I'm better than the best believe I'm the baddest, and you walk right into the ambush and everyone dies, right? So, but at the same time, you can't be the platoon leader that is constantly looking over his shoulder, right? So there's a fine line. And the bottom line is, I worry if you're not growing as a trader. I'm worried if you're growing too much as a trader, right? It's having kids that stress. My kids are wonderful. My son, we were talking about choosing universities and GPAs and how to get a higher. So my wife actually brought to the table statistics, and she's like, okay, if you go to University of Georgia, you need a 3.8 GPA. If you go to Kennesaw, you need I don't think you even need to read to go to University of Kennesaw. Anybody can get in. And then we was like, okay, now how about Georgia Tech? Okay, how about MIT? How about Harvard? And the average GPA at Harvard is 4.1. My son's like, wait, 4.1? I thought 4.0 was perfect. Yeah. Well, he's like, so now he starts asking the real questions now. He's like, so how do you get better than perfect? Does anybody know? How does the average student at Harvard have more than 4.0? Average. Just the basic requirement to get in. Yeah, Georgia Tech, I sat on the board for many, many years at Georgia Tech. Fantastic school. Fantastic. Yeah, it's harder classes. It's curricular classes. So like all advanced placement classes, for example. So if you get an A in an advanced class, you get a 5 instead of a 4, right? So my son, he pauses and he's like, wait, is that why I have the hardest track of classes possible in the school? Yes. Yes, son. That's why you have the hardest possible workload that can be created at your school. This is why. He's like, is that why I'm 2 years advanced in math? I'm like, yeah, because if you want to go to MIT, right, or Georgia Tech, you got to be kind of good in math, yo, right? And so this is why we do like, he has all the hardest classes, advanced classes, STEM classes, all of these things, right? And they did, so both my son and my daughter are state champions in different categories for Science Olympiad. And like, now they're starting to add up. This is why we do public service and all that kind of stuff. It's all starting to add and click, and it's kind of interesting. So are my kids offering stress? No. No. My kids are great. Okay. My son and I tore apart one of my old machines, tore it apart, pulled out all the hardware. What is this, Dad? What's that? What's this? What's that? What's this? What's that? Okay. Harvard says, yeah, you need a 4.1 and be in an Eagle Scout. Well, maybe. Here's what Harvard wants. All right. Here's the secret, by the way, of getting into Harvard. First of all, you have to be capable. So yes, you have to have advanced placement classes and do well. There's no doubt. There's just nobody mediocre at Harvard. So yes, you have to have great grades. Is it why they choose? Okay. 4% of applicants get accepted at Harvard. My special program for grayed hair people, 1% acceptance rate. Okay? Okay, so I'll tell you, you have to be capable. Everyone that applies to go to Harvard has nearly perfect grades. And nearly perfect grades is not even enough, but let's say it could be. Harvard will take anybody they want. So you have to be capable of doing the coursework, but here's how you do it. Here's how you get in. Okay, you prove to Harvard you will be a leader, and you are a leader. So they'll ask a 18-year-old, okay, you have 4.0, valedictorian or whatever, and all this kind of stuff. Great. Valedictorian, great. Good for you. Congratulations. You beat a bunch of drug addicts. Right? You're the smartest kid in your school, but your school's filled with drug addicts. Like, congratulations. Right? What does that mean? It doesn't mean anything. So what's the next thing? How have you been a leader? And how would Harvard help you become a better leader? In what ways are you actively right now at 18 years old trying to change the world? And why do you think Harvard would help you change the world and make it a better place? It's an expectation. Okay? So anyways, getting to this, I worry that you're not doing it or you're just doing what I'm telling you. Both of those are worries for me. Okay? Cool. So we're coming up to a third week. It's not this week, it's next week, right? And very often, not always, but very often there's a rally. Okay? We call it a false rally, or I call it a false rally. So is that going to happen? I really don't know. Two factors going on this year that make this year unique to this year. One is that we have a stimulus. Now they're talking 2T. Now, when that happens will matter, but just the fact they're talking about that would make euro dollar up. Okay? 2 is this whole thing, once again, Trump versus the world. This inauguration, all that kind of stuff. Things could go bad. Okay. Baby doll, many of them are in the day trading course. If not, just go to MetaTraders and pay the $5. Yeah. Cool. Okay. But yeah, it should be there in video number 2 and video number 3 of the day trading course. Okay. So anyway, so let's put this together. If, right, as we get closer and closer to 2 trillion, the 2 trillion will push euro dollar up. This, if there are violent protests over the next few days, in particular this weekend and next week, okay, euro dollar comes down. And this, both of this is essentially lining up with, how will I do this? The 3rd week false rally. Okay. That's not even how to spell rally. Anyway, so this is what I'm telling you. Don't do anything because of a silly pattern or you're counting things or this thing means that. These are like real variables that you may never see again in your trading career. Okay? So you have to, first of all, recognize that these variables exist and then pay attention. Okay? How do you move through the fog of war? Okay? How you move through the fog of war very often dictates if you survive and, of course, who wins. Okay? And that means is you're highly trained, but once you're actually in battle, running through the sand dunes, across the sand dunes or through the jungle, you adapt as you go. You know all kinds of strategies, right? You're very, very well educated. And all of a sudden you're in response mode, right? Like and YouTube, by the way, is great. There's so many videos of soldiers actually in the field with their cell phones recording. And the instinct is to freak out and react, but the soldiers very quickly gather into a strategy, right? Gather into a strategy and say, where are they? They're yelling, they're communicating. Where is it coming from? Where are they? Let's move. You keep the pressure here. Let's move over there. Let's take control, right? And they're adapting every time. Okay? So be very careful. Yes, if you talked to me 5 years ago, would I have been talking about a false rally in the 3rd week of January? Yeah. Well, this time it could happen, and it may not. I don't know. But the idea is to be ready, willing, and able. Okay? So if you were a bull and this was just a regular old month, okay, there's some hope for this, isn't there? Okay. So, should you pay attention to this? Yeah. And of course, the amateur thing to do is this. Not sell, 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 and then start selling. Sell, 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 sells. Right? Way late. Way late. Cool. So you can still sell down here, but you got to remember this was the best price bulls were hoping for. I think as you approach 20, it could get very dangerous. In fact, once we get down near 20, I'll probably very much consider buying again. Okay. But how do you, I don't know. So anyways, there's that. Okay. CAD's still gaining strength on the oil, so that's all gone. So I was saying earlier that there are signs of bullishness in this market, which kind of proves that there's quite a bit of potential for up still. So it seems to be much dollar focused in the moment, but there's a lot of aggressive opportunities here. Okay, this says risk on. Okay, money flowing to South Africa. And even though the dollar's been relatively strong, it's not as strong as the South African currency. And it's exactly where you would expect both price and time. Okay? Looking at peso now. Much less clear, but there's a closer tie to the U.S. economy when it comes to the Mexican economy. And so we have a giant nothing right now, right? This is where the bears would sell. This is where the bulls would buy, and nothing's worked out. Well, I'd hate to be doing something different, right? You certainly wouldn't want to be the monkey in the middle. There's been quite a few good trades here, right? This was a good trade. This was a good trade. There was one in there. This is one I'm still in. Here's one I missed last night, but could have. Again, with the dental surgery and stuff, I've just kind of been not really trading. But I could at least catch that one. I'm not that blind. All right. That, like, come on, bro. I should have caught this one too, right? And I was in that one. Or no, I might have been in this one. Can't remember. It's been a weird week. But the odd part about this one is that buying South African rand, or if you want to say loaning South Africa euros, is this part of it is risk on. I don't really like that. In profit taking is more risk off. But I know if we do get the risk off scenario, dollar strengthens. So if dollar goes up, right? If dollar goes up, then euro should fall. Because that's how we structure it. So remember, now if euro USD, okay, if dollar goes up because of risk off, euro USD falls. So if euro USD falls, euro will fall. And that's kind of, and this will probably be the first trade if risk on return, excuse me, if risk on returns, euro will go up, but South African rand will also go up. And this is a very mediocre trade, and it's only doing all right because of euro being weak. And I expected euro to be weak because of euro dollar. I expected to fall, and it did. So you see what I mean? Classic though, right? So when you're in a situation like this, right? You have the setup first. And once you got it all proved out, this is where maybe your Elliott wave comes in or whatever technique you want. But this idea of down, 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 up, sell, 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 down, 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 up, sell. Okay? The up is your Fibonacci retracement. Now, when you use pivot points also help you to project when to get out. And of course, price action, which is a form of, was what we're doing, which is price action is a form of, Fibonacci, you're measuring price action, right? Elliott wave is, predicting price action. Which I don't think is necessary, but it could be helpful to understand when it gets to a point where it could retrace on the bigger. But I think if you had pivot points, you'll know the prices that will likely create the three-wave correction before it's corrected. So you're not counting waves, you're looking at more like profit zones and entry zones. Same thing, completely different. Okay. Pete, oh, you're on the Eurozar? Yeah. So here's the cool thing. Euro Rand. Okay, you ready for this? Pays approximately 2% in interest. That's better than your bank account. Okay. That's better than a 10-year T-note. That's better than a corporate bond. By the way, not 2% a year, 2% a day. So in 2 months, for example, on interest payment, you'll earn you'll have more than 100%, but you'll have 100% of your money back. Okay. You see? So as long as this is open, I get paid 2% a day. It's not bad, right? That Pete's like, that's why I love it. Yeah, it's actually unbelievable. But that has to do with leverage, though, too, right? Who was it? Hoodoo? Who said it? Yeah, Hoodoo said, isn't ZAR stronger than the US dollar? Yes, that's what this is. In this period, over the last few days, yes. And then over this period, since April, yes. Okay. Actually, I think we're closer to more like a fair market value. Okay. Grumpy Count says compound. Yes and no. Yes, in the sense that you're mark to market and you collect your money and you're already profitable. Right? It's not paper money like a stock, let's say. You have the price you purchased, but then you have the price that it's trading at, and you don't collect the profit until you've sold it. But you do get a dividend. Well, in this case, you get a dividend every single day. Right? And you could trade it, but you're saying compounding. Well, the thing is, very often you can set it up so when you collect a dividend, you reinvest the dividends to buy more stock. In Forex, unfortunately, all you do is get paid cash. So it doesn't really compound. You just, every single day, get $2. $2 a day. Okay? Okay, at the end of a month, you've collected $60. You have $100 invested. At the end of 2 months, you would have $120 in interest rate that you've collected, right? But you only had $100 in the kitty. You only used $100 of your cash. You see what I mean? So you've doubled your money. Your stop is at break even. You do no work. Okay? So you're earning somewhere close to 750% a year in interest payments. Plus, and here's the big thing, pips. Okay? So I shorted this yesterday, so maybe this is a great example. Let's do this. Okay. Okay, I have $121.66 of my cash invested. I have $140 in floating profit. Okay, so I have more than 100% on my first day. I've already doubled my money. My internal rate of return is over 100%. I used $122 to make $142. So more than 100%. Okay? Cool. So the internal rate of return then is more than 100%. The absolute return is I have $142, right? Now, what's the other way of looking at that? Well, of $122, yesterday I got paid $2.42. Okay? All right. So we could do that, right? 2.42 divided by, where is it? 122. Wait. Is there? No, I have to do this clear. Clear. 2.42 divided by 122. Okay? Yeah, 1.98. So exactly, right? 2% a day. 2% a day. Literally. 2% a day. After fees, after expenses, there's quite a bit after converting euro, right? All that euros. So this is a euro rand trade. So after converting dollars to euro and then lending euro to South Africa, I literally every single day get paid 2%. Okay? So now, where did our calculate? Did I kill the calc? Okay, let's bring her back. Let's do some math. I love it. Let's do some math. Calc. Okay? So $2.42 paid to me every single day for a year. Okay? But only have 122 invested, right? 724%. Yeah, you can compound this, compound it by adding more. Okay? Doesn't do it automatically, but you can make another trade. Day trade. Right? At the end of the year, instead of having $10,000 worth of euros lent to South Africa, you could have $1 million. Okay? Now here's the thing. So I'm earning 2% a day, which is 725% a year, but I'm earning 100% a day. I'm already up 100 and something percent. I'm already up 111% today. Plus I'm collecting 725% a year in interest payments. So, right? So for example, if I sold here a year ago, I'd have $725, not quite, but I'm just saying from April to now, let me guess. Okay, from April to now, I would have $555 invested, right? Or collected in interest payments. That's a giant guess, but it's less than a year, but more than 6 months. So let's say I'm already up 555% internal rate of return, right, on collection of interest. But then if you take this and go to that, I can't even read it anymore. Okay. Oh, because it's euro into ZAR. It's 100 billion rand. So I can't even calculate in the value. But let's just say, I'm happy because I'm up $555 on a $100 investment. But if I held it that long, I'd be up $5,000 in pips. Now my $555 in interest payments seem puny, right? So you have to have a long-term point of view if you want to turn $100 into $5,000 or $6,000, right? You want to turn $100 into $6,000. A, learn macroeconomics, and B, stay in the trade longer. This is the oldest trick in the book. It's called carry trading. It's what Forex traders used to do all the time. I know. It doesn't matter. It doesn't matter. Look how correlated they are. Okay. But I was showing you the numbers. Okay. We were over here. Okay. 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 Master Trader says basically you can just stack and pack on more rand and just leave it. Yeah, that's called carry trading. To do carry trading profitably, you're going to need to know macroeconomics. Okay. HK, is that right? HK says, is that per lot position? And Pete says, excuse me, mini lot. Look, you're collecting 2%. You could have $1 billion or you could have $100. It's 2%. You're going to earn 725%, right? It's a bond. Think of it like that. We're bond traders. You're borrowing euro, and then with that, you're going to have to pay South Africa, and then you loan it to South Africa. Okay? So for that, you're going to collect 2% a day. Now, typically you have carrying costs. So in the United States, you're going to have to pay for borrowing the dollars, right? All that kind of stuff. If you're doing USD Rand, because you're leveraging, so you have to pay someone that's lending you the cash. So in the United States, you will have to pay someone for lending you the cash. So you borrow the cash, you borrow dollar, and then you lend it to South Africa. Now, in the United States, you're going to pay 0.25%. Okay? And in South Africa, they're paying 7 something. So in this case, you're probably only going to carry the difference. You're collecting a swap now. You're swapping one currency for another. You're loaning somebody and getting paid in another. So anyways, so what'll happen is you won't make 725% a year. You'll only make 700% a year. Okay? It just so happens you're double dipping on euro because Europe is paying you. Okay? So you leverage up your dollars, so you have to pay for that. But then you invest into euros and they pay you to do that. So euro pays for your carrying cost of your dollar. So now you're borrowing money, but since Europe is paying you and America's charging you, they offset each other, and now the money you're borrowing is free. And then you lend your euros to South Africa, and they pay you interest. Okay? Cool. Now this is where leverage often will matter, Okay, someone was asking earlier today, will it matter if you have 100 to 1 to 50 to 1 or 30 to 1? Like in Australia, you'll have 30 to 1 leverage. You'll just have less leverage. So you're going to still make the same trade. Okay, so you'll still make money pips wise, but the amount of money you'll collect will be significantly reduced as far as interest payments, because you had to put up more money to borrow in the beginning. Okay? So relative to the money you've deployed, you're still going to like, for example, let's say you get in the same trade. So if you're on one standard lot, you're going to need $1,000. Every single day, you're going to get paid $20, $25. Okay? But now if you have to, right, for a standard lot, instead of putting $1,000 down, you're going to need $3,000 down. So you're still going to get the $20, but as a percentage, it'll fall. So the sad story is you're not going to make 725% a year, but you'll make 250% a year. Yeah. Too bad, so sad, right? Okay? Too bad, so sad. Well, but that's true, and of course the risk, right? But that's true in anything, Master Trader. The exact same thing happens in real estate. Okay? Right? It's just math. And these questions, when you study real estate, matter a lot. What are your borrowing costs? How much leverage do you use? So, for example, in real estate, your biggest investor is always the bank. The bank puts up 80%. Okay? So now, if you come in and you put in 20%, and your property, let's say 8% a year, minus your costs, including financing, is 6%. So now you're making 2% a year. Okay? Adds up very high statistically, because you got so little money in the game, and after paying the bank and after paying the expenses, you're collecting 2%, but you only got 20% in the game. So statistically, you'll see that your return is high. But now you say you don't want to do all of this yourself. So instead of doing it this way, you bring in an investor. You're the entrepreneur, so now you bring in a second financier, and you do it this way. Let's make the numbers easy, okay? You put in 10%, they put in 10%, okay? And then you do a deal with these guys that they're collecting different. So anyways, you can get to the point where the investor, instead of going 50-50, might put in 80% of the 20, and now you got hardly anything in, and they get paid certain ways and all that kind of stuff. But at the end of the day, you have so little money into this that statistically, let's say you end up making a 25% return, right? The bank gets 6%, right? And everything else goes to the other investor, but your rate of return, your IRR, your internal rate of return, is 25%. Could be, right? Is kind of the example, because you have so little in game. Another way of looking at it is your leverage to the hilt. Okay? Yeah, so going back to this this idea of the, let's go back to Euro. This setup here, and I've said it multiple times in the live group, in the swing trading group, but it makes sense to say it again now. This setup wasn't about making money, okay? If you remember, we have to look at it from this point of view, okay? It's very possible I talked you guys into these trades, that you had no idea they were coming. You had some guesses, but, oh, if Trump wins or if Biden wins, it's the end of the world and blah, 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 blah. I don't really know what your alpha is, but I definitely made mine clear. Super ridiculously clear. Okay, cool. And it's very easy to just fall into this. Like if you were on your own and you're on this trade now and I decide to take a year off, you're doing this, la-di-da-di-da. Any move like this is very, very significant. First of all, you could potentially lose half the money. Okay? But also, when you go through this and you're the greatest trader in the world, and all of a sudden you're not, what I've seen a million times is that in this period, you start changing. You start adjusting. Why didn't you know? Why is this happening? What did you do wrong? You start losing your confidence. You start adjusting your techniques. And by the time you're down here, you're just a disaster. So here you thought you were the world's greatest trader, and here you can't figure out why you can't do it. Okay? So this setup has more to do with you reducing risk than changing ways. This isn't about suddenly being a bear. It's knowing when to, to trade it and hold it, right? Knowing when to hold it was the whole message down here, and know when to fold it. Okay? So more than anything, we've walked away. Okay? And at some point, if things haven't changed based on macroeconomics, then we're hoping for some up. Okay? That's that. But we don't know. Things can change, and they will change. Right? So if macroeconomics contract because COVID just won't go away, we just are not able to open these markets, right? Then it's all going to collapse on itself. Okay? So this is why, you could be trading this down, and there are variables that could take place where we could be down here by the end of March. Things like COVID problems. Biden dies because he's so old, right? China shuts down. Okay? I think the greatest threat is really just this. Okay? And remember, you can look at the stock market like this. The stock market is betting, quite literally guessing, 6 to 12 months in advance. And we're in a reflation recovery trade. If you remember the behavioral finance of it back in March when I said it's time to start buying, it had to do with in 6 to 12 months, we will be through COVID. Things will be better. Do you guys remember all of that? So what if we find out 6 to 12 months from today, it's still not going to be better? Then people have purchased shares in companies based on values of cash flows that don't exist. by definition, the stock market will be overpriced. And those that were kind of in trouble, okay, might be in disastrous situations. So when you look at Carnival Cruise Lines and MGM, those are two that I told you to take looks at, right? This went from 8 to 30, and MGM, I don't know, is probably $50 or something. Okay, so they're up. I guess the better way of looking at it is this one's probably up 200%, let's say, and this one's up 300%. I'm just guessing that may not be correct, but generally the idea is correct. Oh, not dollar percent. Okay. Why are these stocks up? Well, because we thought that nobody going to Las Vegas because of COVID and having Las Vegas and all the casinos shut, well, that's going to be bad for business, and the stock dropped 90% or some crazy number, right? And then people were buying it because they said, well, you know what, in 6 to 12 months, we'll be through COVID. It's just like a flu. It'll die off naturally. Oh, we'll get a cure. All these things. So someone said, well, you know what, I'm willing to take that risk. So they invested it, and that money went up because that's what happened. People bought it at 8, 9, 10, 12, 13, 14, 20. They keep buying it. Great. But what if the 6 to 12 months come to pass and we find out there is no cure? What if we're rolling out a vaccine for the old COVID and it doesn't work on the new COVID, and now we're like, oh my God. And how long can MGM Grand and Carnival Cruise Lines, for example, right? They borrowed billions of dollars, sold off a lot of their older ships, borrowed billions based on bonds. And what happens to the value of Carnival Cruise Lines if we find out it's going to be another 2 or 3 or 4 or 5 years before we even get remotely close back to cruising? Well, how are they paying for their bonds? You see? So what happens to the stock price now? Okay. So if we get more problems with COVID and the future cash flow never shows up, and then we change our mind and the market decides, oh my God, I bet on future cash flow, but now I understand the situation better, and now I don't think there will be a future cash flow. I don't think we'll get through COVID, and next year people still won't be on cruise lines. So I don't think Carnival Cruise Line could even pay the bondholders, yet alone run a profitable business. And you don't pay the bondholders, that's a breach of covenant, and you go into bankruptcy and you are gone. So if the attitude of the market changes, guess what? Yeah, euro dollar will be down here and lower. And we'll be talking about parity again. It's the end of the world, as I know. But people want to talk about how much money Elon Musk makes. Who gives a crap? Okay? So you need to see reality where we are. So is this a big money-making opportunity? Not in the beginning. The biggest part is how much money I saved you by having this equivalent to an earthquake you put on your calendar. Oh, December 19th, earthquake day. You were ready, willing, and able. You were prepared, right? But mostly to save your personal property, aka your cash. So now what? Now what is your outlook? Is this a long-term short? Or is it a short-term short? Well, how do you make that determination? Well, for example, investors around the world need to make decisions. How will they make their decision? How will you know if the U.S. stock market's going to be higher at the end of the year. Well, what's their financial analysis of these corporations over the next 6 to 12 months? Pretty simple. If we're through COVID and the cure is on its way, the next 6 to 12 months will just be fine. Then it'll rally. If the next 6 to 12 months we find out there is no cure to COVID, we haven't even cured the flu, for crying out loud. Maybe you can't cure COVID. Why do people get flu shots every year? Okay? So, if you don't think there's a cure and we won't fully open and those cash flows that people have already bet on don't show up, then those stocks are overpriced. Okay? 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 So what we care about is future cash flows. Okay? Google's expensive because it makes money regardless of COVID. Amazon's expensive because it makes money regardless of COVID. And those CCLs of the world and the MGMs of the world, if they don't get customers back, then maybe a 300% increase in stock price since April is too much. Those are giant bets on cash flows returning. Millions of people gathering in Las Vegas simply for the sake of spending money. Maybe that don't happen none. And if so, maybe it's overpriced. Because remember, price is simply calculated from cash flow. Okay? I can tell you exactly what a building is worth to me. Okay? So here's an apartment building. And everyone in this room is in a bidding war. We all want to buy this building. Who wins the auction? So you look at your cash flow, cash in, minus your cash out. Okay? That gets you your NOI, net operating income. Okay? But now you take that NOI and you put this over a period of years. Okay? Starting your first year is 0, so there'll be a cash out. You paid $1 million, so you're negative $1 million in year 1. But in year 0, year 1, you have rent minus expenses, so you have your NOI. In year 2, NOI, 3, 4, 5, okay, refi, 6, 7, 8, 9, 10. So you have all your cash flows laid out, doing each year time value of money. In year 10, you sell it. So now you have your NOI that year plus the sales price. Okay? So you line it all up. You do the time value of money on everything, and at the very end, you get a price. You get your value, okay? So now, who gets the apartment building? Who wins? The highest bid, okay? Right. But how are they willing to pay a higher price than everyone else? Okay. Shouldn't we all agree? Cash flow, okay, Positive cash flow minus negative cash flow, there should be some money left over and over a period of time. So let's say you make $500,000 a year, right? Rent minus expenses, you make $500,000 a year. So after 10 years, you collected $5 million. What's this thing worth? What's this thing worth, right? It's the person with the lowest borrowing cost. Okay, so there's John, there's Jane, and sorry, Jim, and there's Jim. Okay, I'll make it work out for Jim. John goes to the bank, he's got moderate credit, and they're like, we'll give it to you for 4%. So now it's cash in, which is rent, cash out, which is expenses, out, okay? But you had to borrow money. So now you have borrowing costs. I don't have to write the whole thing out. Borrow cost. Okay. Okay. So now you have this borrowing cost. John pays 4%. Jane pays 3%. Jim has cash. So Jim pays 0%. He's got the full Monty right there in his hand, right there. So when you add this up now, the cash flow over time, the highest bidder is always the person with the lowest cash, because at the end of the period, right, it's worth more. Jim can afford to pay more. So it's not the highest bidder, it's the lowest carrying cost. It's a carry trade. It's not necessarily the largest down payment. There's lots of things that go into it. John could have a larger down payment than Jane, but his credit score isn't as good. Or his debt to equity ratio isn't as good. Okay? Jim just sold a building and has cash. So he has no debt and giant bank account. So he can come in and just say, well, I'm going to take the whole wad of cash and just buy this cash flow. Okay? So it's ultimately a carry trade. But my point here too is we can all do the same calculations of cash flow, cash in, cash out. Okay? Produces $500,000 a year of net operating income, but John has to pay $450,000 a year, right? $350 a year, and Jim collects, right? So, right? So John only makes $50,000 a year. Jane makes $150,000, and Jim will make $500,000. So now you can do your calculations, and now we get different prices. Okay? You see what I mean? Now we get different prices. John will pay less than Jane. Jane will pay less than Jim. Jim wins. But Jim paid the most. Okay? So the price is an illusion. Okay? Because Jim could pay more. Let's do it this way. Maybe this will make the impact. Jim will pay more. Okay? So now John only makes $50,000 a year. Jane pays, right? And now Jim could pay a price so high that he also only makes $150,000 a year. Okay? But that means to make that happen, he had to pay higher price. Okay? And that knocks Jane out because after a while, if Jane keeps paying more, all of a sudden, like, now she's only going to make 50 grand a year. And she's like, nah, I got better opportunities. So John's out, Jane's out, and Jim will get it at Jane's breaking point. And the difference, the illusion is that Jim paid more? No. Jim didn't pay more. It cost him less. It might have cost him the same, in fact. The same as Jane. Okay? Because the flow, if Jim makes $150,000 and Jane makes $150,000 a year, everything else is an illusion, right? Price is sort of irrelevant. So anyways, so even real estate is a form of carry trading. And of course, the most important part of a carry trade is your borrowing cost relative to the payments that you collect in your cash flow, right? Well, so Michael, what happens in real estate is, so Michael says it's a form of game theory, except it's blind, so you can't signal and stuff to other people, although you can. It's not in a structured way of signaling because you don't know all the bidders, but you often run into them or you can do things. But very often a real estate investor will go to 10, 20, 30 properties and keep getting bid out. Okay? Think of it that way. And he sits in his leased Mercedes, right? GLE. And he cries. He's like, "Oh, dang it! Everyone is paying too much." It's not true, is it? This investor in his leased Mercedes GLE is driving around deal after deal, dozens of deals, and he always is outbid. Always. He loses every deal, and he's like, "I can't believe it. These guys are paying too much. They must be crazy." What's his mistake? Are people paying too much? Are they overpaying? What's going on here? What's his mistake? Yeah, CJ's doing a 1031. Well, often that's actually what happens, right? No, it's not the analysis per se. I mean, that obviously that could be something. Needs more cash? No, he doesn't. No. Think about what I just taught you. It's not price, guys. What's his mistake? People are not paying too much. It's not that he doesn't have enough cash. It's not the real answer. No, now you're getting philosophical. Wait. No, his borrowing costs are too high. He's running around trying, and he's got everything locked up with his financier, his banker. His banker says, "Look, I'll give you a line of credit. We're good to go whenever you're ready to pull the trigger. And the mortgage, you can buy something up to $1 million, right? You've seen these, right? You've seen these. You got a letter, a document, says Bank of FU is ready, willing, and able to lend Dum Dum $1 million at 3.5%. Everyone else is running around with a letter that says less than that. And therefore, when you do the analysis, and I guess that's where Jim's going, but when you do the calculations, because analysis could be wrong market, wrong, a lot of things, right? But it just comes down to the financial analysis. His borrowing costs are higher than everyone else, so he can't afford, right? He can't afford the higher price, but everyone else can because their borrowing costs are clearly lower, and they're all trying to make the same kind of buck. That's the interesting thing, right? People are saying to themselves, I'm not going to do this deal unless I know I'm going to make $500K a year. Yeah, but how do you make $500K a year? Well, it's your money coming in versus money going out. Your money going out is expenses plus your financing costs. So if your financing costs are higher, you can't afford, right? You can't afford the higher price. And if you keep getting bid out, it's not that other people are stupid. You don't have a very good deal with your banker. Okay? Therefore, he has to lease a stupid car because he don't got no money. Interesting, right? It's not price. Price is an illusion. It's all about cost, borrowing, interest rates, macroeconomics, business cycles. Is that right, Pete? Bought a house 30-year fixed. So what was it, about 300,000? No money down though, so it must have been even. So what is there, there must have been like a VA or some other type of low interest loan, because 1.6% with no money down? So it must be cheap, must need some help. What part of the world is that, Pete? Wait, you're in Holland, aren't you? In the Nether. Oh, that's amazing, dude. That's amazing. That's amazing, though. That's good. That's good. Probably had to prove that he wasn't a flipper as well. But that's good. That's great. Honestly, awesome. Very happy and proud of your son. Yes, it couldn't be jumbo, but no money down and still 1.5. That is amazing. Yeah, in the Nethers, huh? That's amazing. Okay. You see this? We have this set up from a bearish point of view. Okay. There's the sell zone, predefined. Here's the sell zone, predefined. Here's the sell zone, predefined. And right now, we're in next week's sell zone. Pretty amazing, huh? It's not really what I expected, but again, this shift, I think, had a lot to do with the surprise by OPEC. But notice we had this risk-off move, and we nailed it for a while. And then they're like, wait, what? Okay. One concern here is we're not hitting targets. So we must be bunched up on support. You can just tell because we're never hitting targets. Looks like I lost most of you guys when we went into the finance discussion and real estate discussion. Most people, I guess, are looking for just pure Forex. To me, it's just money. Okay. So looking at that rand, I was trying to show you the importance of cash flow. Yes, those are dailies. Yes. Just kind of just looking around here, thinking quietly. I'm cold and I'm ashamed, lying naked on the floor. Illusions never change into something real. All right, just kind of following it through. This goes all the way back to November. Yeah, you can see the hesitation at the end of the year and now at the beginning of the year. So I will call this like a hesitation. Like that's 100% retracement, right? And then I would look at this as another hesitation. Okay. And this, we set this Noki up based on Brent, if you guys remember. Remember that? Buying Brent. So we're selling this. Yeah, Jim says very interesting. Had not looked at real estate, and so now you'll see like. And, you know, I wish it was taught better, or I wish everything was taught better. But if you got the financing part done first, then you know you're competitive, right? The only other way to kind of win the game is buy something that is distressed, but even then there are people that specialize in that, right? So I think you're always going to be competitive. There's always going to be competition that no matter where you participate in the market. So for you to be successful, you have to have the skills everybody else does. But the way you win the game is not by taking on more risk. So a lot of people, let's say, they'll pay a higher price. They'll bid against Jim with his low or free money, right? The low cost or free money. But what'll happen is they're just assuming more risk and they're doing it for less than the 50K. That's the other way to do it. But those guys do go out of business. And so you might argue with me. You're like, Wayne, no, the guy sitting in his leased Mercedes GLE, he's right. They are paying too much. And there you go. And then you get Michael, that is not a slight. That's a huge. Okay. Yeah. Yeah. Pips are worth it, but that's a huge negative carry. So the way that you would deal with that is, first of all, you wouldn't look at it on a 4-hour. I mean, you would analyze it, but we made this decision without even looking at a chart. When I brought up USD Noki, we were selling it purely based on our analysis of Brent crude. Remember, WTI was at 30 and we're predicting it goes to 50. And I said, well, if that's true, then, Brent is probably going to go to 60 and therefore Norway is going to benefit. And so one way to play that, the increase in oil prices could have to do with positive macroeconomics, in which therefore the US dollar will weaken, and the positive economics would increase the demand side of the energy equation, which Brent would go up, pushing this, right, currency pair down. Didn't even need a chart. So you start with that idea, and then you carry it out with your technical analysis, doing things like, the first part you could do is like swing trading bearish. Let's open this up and do last 20 weeks. Okay. And you'll see that based on that simple assumption, sell, no opportunity, sell, 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 loss, Oh, look, the 19th of December. Sell, sell, and now you're very uncomfortable. You sold and you're uncomfortable because it's going nowhere fast. Okay? You see? Now your year could have just been that. Okay? You would have exited down in here. So one, no trade here. Oops. So you got one, oh, dang it. You have 1, 2, 3, 4, 5, 6, and then we'll say this is out. Okay? 6 trades in 7 weeks. Or you could say, no way, Jose, you can't predict this. Okay, fine. 5 trades in 8 weeks. Okay, but remember, this had everything to do with oil prices. Okay? And it just so happened that this, and I think the market is behaving in a way that shows people didn't quite predict the Saudi Arabia OPEC Plus deal, and they don't know what to make of it. So if Saudi Arabia cuts and the rest of OPEC cheats and raises, what's the net effect of that? Nothing. Right? So now they're like, so what does it mean? Right? And you can see the conviction is gone. So you're like, huh. All right? Or we were correct in assuming some dollar strength here based on seasonality. And now we're waiting to figure out when the next move down is. So, it's interesting, right? But this is why you shouldn't focus on 19 different currency pairs. You should be a master of one thing. Now, the interesting thing is you're like, well, what one thing? Well, there isn't actually a one thing. The one thing would be Noki and dollar and Brent. That's the one thing. Brent versus Norway versus USD. All wrapped inside of a beautiful box called macroeconomics. Because remember, global macro now impacts Brent, impacts the United States, and impacts Norway. Contraction brings demand down for Brent. That's going to hurt Norway. All of that creates a risk-off feeling. People get out of investments, bring the money home, and shove it into U.S. bonds, and the dollar gets strong. Or vice versa. Okay? And knowing the ebb and flow is helpful. But I would focus on the one thing. What's the one thing? Okay? And then, as a macroeconomic trader, then you specialize. That's where you say, well, I like the energy complex. And you live in Europe or something, or that's a better time zone for you. So you're like, okay, so I'm going to look at European oil. Okay? And maybe Noki, maybe USD, maybe Euro. Okay? For example, so ECB and Fed. Okay? Okay, you see all that? And then you're like, well, what else could I do here? You could do China. You could do OPEC. You could do, right? And you start laying layers of analysis on top to give you a generalized view of the world. Okay? You can make it as complicated as you want later. Many of you are looking at everything and specializing at nothing, and you don't know where any of this information fits. Now, if you were sitting there thinking, okay, your European centralized focus, you're studying macroeconomics, so clearly you need to focus on the ECB. And how could you measure growth in the global economy besides just reading statements and stuff? You can say, well, energy is important to growth. So you can say, okay, and you live in Europe, so you want Brent. So what else do you know? Well, if Brent's going to move, Noki's going to move. Okay, if macro is positive or negative, the dollar's likely to move. The Fed and the ECB are going to tell us something. If you focus a lot on Brent, you might want to look at OPEC and all this kind of stuff. And 5 years from now, you'll just be very good at that one thing. Macroeconomics and the analysis of the European economy respective to the globe. Okay? You see? But you don't have to start, right? Like the weirdest thing is when people say, and I pick on it lately, but I don't even have it. So they're like, yeah, but what about the the Euro Kiwi? Okay? And I look at it and I'm like, that's so different from this other thing that I just showed you. Okay? The value of the Norwegian currency is directly tied to Brent oil. And Brent oil is directly tied to macroeconomics. Okay? I mean, just this pair alone you could start with. And then tie in other things, right? But like, what the hell is the connection between Europe and New Zealand? How does that explain the ebb and flow of cash to and from these economies? Well, the most interesting thing is you have to realize there's euro, euro versus everything. Okay. And then there's New Zealand. I'll just do it this way. New Zealand dollar versus everything. Okay. There might actually be, almost statistically speaking, right, nothing flowing between euro and New Zealand. Like it could be, let's say, less than 1% of the flow of euro around the world. All right? Less than 1% of euro flows to New Zealand and back. Of all the euros floating around the world. We know 40% of them are with the US, right? So like of what actually goes between euro and New Zealand, which is demand, it's less than 1%. So you're like, well, I see this chart moving up and down, Wayne. And I'm like, yeah, I'm sure you see these patterns. Great. But it's not a direct tie. It's just what euro happens to be doing today, which could look like this. Right? Versus New Zealand, which might be doing this today. Okay? And the way you're setting up your trades now, and I'm not saying you can't do it. In fact, a lot of you guys are probably making fantastic money, but I'm trying to tell you that you're trying to time this with this so that you're trading this down. But once again, there's a high probability that's an illusion. It's not actually money flowing to and from Europe. It's just euro might be weak today relative to everything. Kiwi might be strong today relative to everything, and you're trading these things indirectly because of their valuations in the moment, but not because of each other. Not because, just is. But not because the why to me is missing. Versus Noki is strong today because demand for Brent, aka price for Brent, is up today. Okay? And this might be a sign of positive macroeconomics because you're like, well, why is demand for Brent increasing? Oh, well, COVID's going away. China's coming back online. The Americans are spending more. Europe are crawling out of their socialist dens and whatever. And boom. And so if this is going up, that's going up. And if that's going up, that's going up. And you're making direct investments now into a strategy because of something. You know the why. Versus something that just is so indirect that it could be right, it could be wrong. Now, hopefully you're on big trends, but maybe the big trend is great. But even in a big trend where, let's say, euro is systemically weak, okay, and New Zealand is systemically strong, so therefore euro Kiwi would fall. Here's my problem. If we get good global macroeconomics, okay, so now we have an improvement here, I would expect euro to go up, and I would expect New Zealand to go up. And therefore now you're trading, just like I was showing you with Elliott Wave and stuff earlier, you're trading this kind of noise in something that's generally up and something that's generally up, and you're doing your darndest to be consistently able to pick in the day or even in the hour that Kiwi is weak while euro is strong and making money that day. That seems to be like the most difficult way to make money in Forex. Now, you can do it, but I would say, like, just logically, if I were to map this out like I just did, I'm like, I bet you if you can make money doing that, if we just change the why, not how you're trading, if you're making money consistently doing that, you're probably a very good short-term trader. And I respect you for that. I really do. But now if I can take your specialization in shorter time frame, relative strength style trading, and I make the relative strength more permanent based on, macroeconomics, and we take your trading skills and we put it on a slightly on a different pair. Oh my God. Oh my God. Oh my God. You're probably you'll probably be an amazing trader. You'll go from a good trader to an amazing trader. But you're like, that's all macroeconomic mumbo jumbo. Whoa. Okay? Imagining taking your skills with George Soros's brain or experience or thought process. If I could just sprinkle some George Soros pixie dust on you, oh my God, you're going to be like an amazing trader. The world's greatest, the greatest there ever been. Better than the best. And that's what I want for you. Okay? So thank you for being part of this community. Thank you for being a client to Trader's Way. Thank you for being a student at FX Bootcamp. I'd like to remind you that we're meeting for their swing trading meeting at 2 p.m. So in approximately 4 hours, we're getting together to plan next week's trades. And next week it's going to be interesting. Excuse me. Could be interesting. I don't know if we're going to get riots next week or not. It's going to be interesting. So I'm very glad that we can handle this as a community and be prepared. So 5 hours from now or 6 hours from now, we'll probably have 10 different trade plans in 30 different scenarios. Could be very interesting. So looking forward to that with you. If you want to be part of that group, of course, visit fxbootcamp.com, insert a credit card. You sign up for videos first, and it says, hey, you're taking video training. Would you like some hand-holding as well? Why don't you join our live group? Some people have been in the group for 1 week. Some people have been in the group for 10 years. 2 people have been in the group for 15 years. Right, Adam and Jim. Yeah, family. So anyways, that's how you do it. That's how you get involved. That's how you take control. That's how you battle the beast. So peace on earth. May the pips be with you. May your profits be above average. I will see you tomorrow. Cheers.